Welcome to the Ontario Mortgage and Real Estate Insights Podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today we're looking at a significant proposal from the Ontario government aimed at tackling the province's ongoing housing supply crisis. As part of the Cutting Red Tape, Building Ontario Act 2024, a series of legislative and regulatory changes have been put forward. These proposals are designed to remove barriers to development, enhance regulatory efficiency, and ultimately increase the availability of housing options for Ontarians. A key element of these proposals is the effort to simplify the process for homeowners to construct additional residential units. This includes structures like garden suites, laneway homes, and basement apartments. The new rules aim to standardize requirements throughout the province, which would significantly reduce or even eliminate the need for rezoning or minor variances. By cutting down on bureaucratic red tape, the government hopes to save time and costs for homeowners while speeding up the creation of new housing units. In addition, the Ontario government is looking to address the delays currently plaguing the Landlord and Tenant Board. Proposed legislative amendments are intended to streamline tribunal operations, reducing the backlog of cases and improving access to justice for both landlords and tenants. This is a crucial step, as the efficiency of the board's operations directly impacts the housing market's stability and fairness. Moreover, the government plans to enhance the Ontario New Home Warranties Plan Act. This would empower TRREB, the province's home warranty program, with greater authority to identify and act against illegal builders. These changes are aimed at protecting homebuyers and ensuring that compliant builders are not unfairly disadvantaged by non-compliant competitors. To further address housing shortages, particularly in Northern Ontario, the province is considering allowing building officials from Manitoba to practice in Ontario. This could help alleviate staffing shortages in critical areas. Additionally, Ontario is looking to streamline municipal reviews of engineer and architect-stamped building designs, which would expedite the approval processes. The government is also exploring ways to better manage its real estate assets by centralizing oversight under the Minister of Infrastructure. This move could lead to improved efficiency and oversight of the province's real estate portfolio. In a bid to support builders, the government is encouraging the use of pay-on-demand surety bonds as an alternative to letters of credit. This change could potentially unlock funding for developers while still maintaining financial security for municipalities. While the Ontario Real Estate Association has expressed support for these measures, they have also called for more aggressive actions to address the housing crisis. The association has highlighted the need to eliminate exclusionary zoning and increase upzoning near transit corridors to effectively build the 1.5 million new homes needed by 2031. OREA President Rick Kedzior commended the government for its efforts, but emphasized the necessity of bold actions to truly resolve the housing supply crisis in Ontario. The Toronto Regional Real Estate Board, or TRREB, is raising the alarm over a significant backlog in Ontario's Landlord and Tenant Board. With over 53,000 unresolved cases, TRREB is advocating for reforms to address these inefficiencies, which are exacerbating an already strained housing market. Their newly released report, Breaking the Backlog, Restoring Fairness and Justice to Ontario's Landlord and Tenant Board, highlights the challenges faced by both landlords and tenants due to these delays. Jennifer Pierce, the president of TRREB, has emphasized the necessity of reforming the tribunal to improve confidence among landlords and tenants. Pierce stated, "Ontario is facing a housing affordability crisis and a real shortage of rental housing. The province is taking important steps to improve the operations of the LTB, but further action is needed. We must fix the problems at the LTB to give landlords more confidence to bring rental units to market and support tenants. The inefficiencies at the Landlord and Tenant Board have made it difficult for landlords to resolve disputes efficiently, often discouraging them from entering or remaining in the rental market. For tenants, these delays can lead to financial uncertainty and prolonged instability. TRREB's report offers 10 recommendations aimed at improving the tribunal's efficiency and accessibility. Among the proposals are reinstating in-person hearings, strengthening digital infrastructure, and enforcing stricter timelines for hearing and resolving cases. John DeMichel, TRREB's chief executive, pointed out the urgent need for meaningful reform, saying, "With a major backlog of cases at the LTB, we see an urgent need for meaningful reform that ensures fair and swift resolutions for landlords and tenants alike." One of the key recommendations is to ensure hearings and decisions are completed before a tenancy's termination date, preventing disputes from dragging on for months or even years. Another proposal is to upgrade the landlord and tenant board's technological systems to make processes smoother for everyone involved. The Ontario government has already indicated its intention to act on 2 of TRREB's recommendations as part of its fall 2024 red tape reduction package. These proposed changes would allow the landlord and tenant board to overlook minor errors in applications and streamline the reassignment of cases to new adjudicators, thereby reducing delays. John DeMichel remarked on TRREB's long-standing advocacy for reform at the landlord and tenant board. TRREB has long been a champion of reform at the LTB to make the tribunal more efficient for both rental property owners and tenants. "We're proud to be working with Minister Downey and his team on the latest round of reforms to the LTB," he said. Today, we're delving into the intriguing divergence between fixed and variable mortgage rates in Canada. This divergence is becoming more pronounced as the economy evolves, influenced by shifts in bond performance, policy decisions, and market conditions not only in Canada, but also in the United States. Understanding this divergence is essential for homeowners and prospective buyers looking to make informed decisions about their mortgage strategies. Let's start with variable rates. These rates might see a decrease as the Bank of Canada continues to cut its policy rates. On the other hand, fixed rates could remain steady or even increase due to rising bond yields, which are under pressure from a more robust US dollar and economy. This divergence means that having a personal mortgage strategy is more crucial than ever. In the third quarter of 2024, Canadian government bonds, especially short-term ones, performed well, delivering positive returns. However, longer-term bonds face challenges with rising yields. So far this year, Canadian bonds have outperformed most G7 nations, partly due to currency advantages. High-yield Canadian corporate bonds have also outpaced investment-grade options, driven by shifting economic conditions and growing gaps between Canadian and U.S. bond spreads. In this context, mortgage rates have come under pressure. Fixed-rate mortgages are primarily influenced by government bond yields. Rising yields often lead to higher fixed mortgage rates since borrowing in the bond market becomes more expensive. Conversely, variable rates, which track the Bank of Canada's overnight rate, adjust flexibly with each policy rate change. This flexibility could offer some relief to borrowers if the Bank of Canada continues to lower rates. The recent U.S. presidential election has added volatility to the bond market. Bond yields initially spiked following the surprise result, but quickly receded. Despite the short-lived surge, investors remain cautious, and Canadian bond yields continue to be influenced by U.S. Treasury pressures. As a result, Canadian fixed mortgage rates, which are pegged to bond yield performance, could stay steady or increase, while variable rates may decline alongside anticipated Bank of Canada rate cuts. A strengthening U.S. dollar often reflects challenges in the global economy. Investors seeking safe assets during economic uncertainty tend to favor the dollar and U.S. Treasuries, creating a cycle where economic slowdowns fuel dollar gains. This, in turn, impacts global conditions, with emerging markets feeling the most significant effects. The stronger dollar raises import costs, curbing demand and slowing trade volumes, particularly in regions like Asia and Latin America. On the financial front, dollar-denominated debts become costlier, increasing repayment burdens for countries and companies without dollar-based revenues. Rising interest rates in the U.S. further reduce global investment appeal, pushing capital out of emerging markets and forcing them to raise rates despite economic slowdowns. Recent spikes in global bond yields highlight the interconnected pressures central banks face as they try to support growth amidst tightening monetary conditions. The U.S. Federal Reserve's recent policy rate cut by 0.25% aims to balance inflation and economic uncertainty. While the Bank of Canada continues its monetary loosening, variable rate borrowers may benefit as further cuts are anticipated. These cuts could ease the cost of borrowing and monthly mortgage payments for variable rate holders. However, fixed rates are likely to remain elevated due to bond yield pressures and other macroeconomic factors. Canada's labor market added fewer jobs than expected in October, but wage growth has risen, sustaining inflationary pressure. Rising labor costs and stagnant productivity put the Bank of Canada in a cautious position regarding aggressive rate cuts. This affects mortgage rate projections. Fixed-rate mortgages tied to long-term bonds may not significantly decline, while variable-rate borrowers could experience relief if the Bank of Canada resumes rate cuts to counteract the employment slowdown. Bank of Canada Deputy Governor Carolyn Rogers recently highlighted the mortgage renewal wall Canada faces over the next 2 years, as numerous borrowers will renew at higher rates. While Canadians historically manage mortgages well, the Bank of Canada cautions against government interventions that artificially lower short-term borrowing costs, as these could have lasting economic impacts. This sentiment reinforces that fixed rates may remain relatively high, even if policy rates are cut. Given the economic environment, variable rate mortgages seem likely to experience some reduction in the near term as the Bank of Canada's rate cuts gradually pass through. Fixed rates, however, are more influenced by long-term bond yields and economic uncertainties, including the influence of U.S. Treasury yields and inflation expectations. Former TD economist Don Drummond has suggested that the ultra-low fixed rates seen in recent years were an anomaly and expects rates to stabilize closer to historical norms. For Canadian mortgage borrowers, these dynamics underscore the importance of evaluating individual financial circumstances when choosing between fixed and variable rates. Variable rate borrowers might find relief as policy rates ease, potentially offering savings. Meanwhile, fixed-rate borrowers may not see significant reductions and should consider locking in a rate for stability, especially if bond yields continue to climb. Economic signals, such as bond yields, employment data, and inflation rates, will shape the trajectory of mortgage rates in the coming months. Fixed and variable rates could continue to move independently, making mortgage choices increasingly nuanced for Canadians. It's crucial to weigh the stability of fixed rates against the potential savings of variable rates, considering current economic forecasts and individual financial resilience. In recent news, Dominion Lending Centers Incorporated, a major player in the mortgage broker network, has announced some significant leadership changes aimed at enhancing their technological capabilities and streamlining operations. This comes as part of their ongoing efforts to remain at the forefront of the industry. The company has promoted Steve Mitchell to the position of Chief Information Officer, or CIO, while parting ways with their Chief Technology Officer, Sławek Kaunaki. Mitchell, who has been with the company since 2017, previously served as Vice President of Information Technology and Applications. His pivotal role in the development and success of the Velocity platform has been instrumental, and now he will oversee all technology operations across DLCG and its subsidiaries. The leadership shuffle aligns with DLCG's recent achievement of Service Organization Control 2 Type 2 certification for their Velocity platform, which is a benchmark for information security. This certification confirms that Velocity adheres to strict standards for protecting client data, ensuring that their partners' data is managed in a controlled and secure environment. Gary Morris, co-founder and chief executive officer of DLCG, expressed his confidence in Steve Mitchell's capabilities, stating that as information, technology, and security are fundamental to their business, it is crucial to have a cohesive and integrated technology department led by someone as trusted as Steve Mitchell. Morris also emphasized their commitment to maintaining DLCG as a technology leader in the industry. Meanwhile, Sławek Kaunaki, who joined DLCG in 2019 and played a key role in maintaining a stable technology environment, is departing the company. Gary Morris extended his gratitude to Kaunaki for his contributions over the years and wished him well in his future endeavors. Dominion Lending Centers, headquartered in British Columbia, operates through subsidiaries such as MCC Mortgage Centre Canada, MA Mortgage Architects, and Newton Connectivity Systems, supporting over 8,500 agents across 500 locations. Their focus on technological advancement and secure data management continues to position them as a leader in the mortgage market. That wraps up our coverage on DLCG's leadership changes. It's clear that their strategic focus on technology and security is aimed at reinforcing their position in the industry. As always, we'll continue to monitor developments and bring you the latest insights. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder: Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time, and stay informed with the latest industry insights.